Audit profit and loss statement. Now let me just give you a perspective and repeat what has been just mentioned. Any business has different segments. Some will have profits, some will have losses. What we will do is we will aggregate them and we will report it. So where does this lead us to a very financial, very important strategic decision? The strategic decision that you will have to do when you are analyzing, when you do a business, when you are leading a senior management is, if I come and say, we made 100 crores profit, the first thing that you would ask Mr. Sunil is, Mr. Menon, this is great, you have done 100 crores profit, very good, Mr. CFO, we are very happy that we made 100 crore profit. Can we have the distribution segment wise? Can I have the distribution segment wise? Look at Wipro. Let's talk about practical companies, it's important. Let's look at Wipro. See, segments can be product wise, segments can be geography wise. It's the way you want to classify it. Logically, Wipro is into so many business. Moment you take the segmental business, you realize, oh my God, now I realize when I look at Wipro, good or bad, that is for you to analyze. But this is what the statement says. Now I realize Wipro is getting, it's there in everything. It's there in Manaspatis, it is there in soaps, it is there, name it, it is there, but it's getting its major income from IT operations. Then, let me now incorporate your answer. Maybe not Wipro, maybe a company which is making losses. The next statement that you would ask Mr. Sanjay is, considering, this young man would ask is, right, considering that this product is making losses, considering that this region we are losing money, should we continue with that product? Should we continue to be in that geographic region? Questions logically start coming when you ask for the breakup. Finance guys will give you only the consolidated statement. You should logically ask them to break it up segment wise. A profit and loss statement indicates profitability. A profit and loss statement, what you should ask for is a breakup, which is known as segmented reporting. Once you have segmental reporting, you can come out with turnaround strategies. You can decide your core competency. You can go back and talk to your management. What should be your future growth strategies? Having said that, let's take the second statement. And this is where I like to involve Sunil sir here. So Sunil, I am the colleague who is involved. I take material from Mr. Akhil at 100, sir. 100. I process it at 10 rupees processing, sir. And I sell it to Mr. Yashpal at 140. 110, 140. Okay? Thanks for nodding, Mr. Mani. Senior, very logical question. Sir, I am a profit.
Yes.
Thank you. By how much, senior?
30.
Thank you. Now comes the twist in the tail. Thank you for promptly responding, sir. Now comes the twist in the tail. The twist in the tail is, both my colleagues, is Akhil is a very hard negotiator. After all, he's doing the FFB course, you see. Right? So, right? Very hard negotiator. He says, Mr. Menon, 100 rupees. Okay? I said, thank you. But pay me now. 100 rupees, pay me now. Can I pay you after 1 month? No. Pay me now. So, fine. We're going to end our day with a very important consideration. But today we'll start with this. We'll end our day with working capital management. So 110, 110. So one of my colleagues will take this question. I am selling to Mr. Yashpal, who incidentally is equally very good at negotiations. So he says, Mr. Menon, I will pay you 140, but I will pay you after 6 months. 100 rupees I have to pay upfront, but I receive 140 after 6 months. Any one of them, I need a quick response, and I'm sure I'll get it. What do you think, sir? Sir is very correct. He said I'm profitable. I'm obliged for that. But am I going to get into any problem here? Thank you for nodding. Mr. Kapil, Mr. Akhil said that the cash flow statement. Sunil sir, I was profitable, thank you very much. But as the entire audience immediately logically connected and said, इसमें कुछ तो problem होने वाला है Menon को. Somebody took it one step further up. He analyzed it. Kapil really brought in the point. He said, Mr. Menon, if there is a credit risk, what is credit risk? If If Mr. Yashpal does not pay me, then I am dead. But I am not even taking it to that level. We will talk about that in working capital management. I am only telling you that beyond profitability, there is something known as liquidity, and that is given by the cash flow statement. That's finance for you. So if somebody comes and says cash flow statement, why does the cash flow statement exist? It shows liquidity. And now can I use some very, very simple things that I always tell these young friends who are in business? Cash is king. Thank you for smiling. Cash is king. Profit is on paper. You said that, sir. Yeah, it was you, Mrs. Sanjay. Profit is on paper. Cash is king. 80%, I'm raising my voice as far as possible to the would-be entrepreneurs and to the colleagues who are already in business. 80% of sickness is in the SME sector is due to working capital problems. Profitability is very, very good, but the guys can't manage cash. The guys who can roll money, I hope I am using these jargons, who can roll money properly will be the ones who will survive. And you don't need an MBA degree for that. An MBA degree is good. What you need is business logic. As simple as that. In this case, I was profitable by 30, but yes, there is a serious problem of liquidity. At this stage, I will leave it at that and tell you it is the cash flow statement which indicates liquidity. Two statements, profit and loss, cash flow. Now we go to the third statement. I know these colleagues are aware it's balance sheet, but I want to introduce it in a logical way. Right? Not to say the other colleagues don't do it, I'm sure all academicians are good, but look at it slightly differently. And there is a third statement coming up. For that I'll go to, everything is linked to practice. I'll go to Dubai. So here we are. We started with last slide to grow. We talked about SME sector, cash flow management. That's what you colleagues are expected to do. That's why possibly your finance guys are after your blood. Obviously there's a way of doing things, but that's the reason why they are after your blood. They keep coming back and say collect. But it's about cash flow. Let's look at a third thing now. Let me just ask one of you, especially what happened in Dubai, and that's connected to the third statement. It is the balance sheet, but I don't want to show you slides and say balance sheet. Let's look at the third statement. Ishwari, what is it about the Dubai crisis? Let me put it in a positive manner. You guys are right actually. Dubai has very little oil. Let's get this straight and clear, sir. Vishal, you need to understand. Dubai has very little oil. Abu Dhabi, Saudi, these guys have oil. So now the Dubai government was given an idea. Said, how do I grow? I don't have oil. So, okay. Do one thing. Use a Singapore model. That's the best way to grow. Now, what is the Singapore model? Right. Mr. Sheikh, the Singapore model is very clear. Convert yourself as a financial services center. Convert yourself as a trading hub and convert yourself as a leisure hub. Then what? All the Europeans will come, all the Americans will come. You will have money which is coming in. Through leisure, they will come here, so you can build the biggest mall in the world. Great. You can build the biggest building in the world. Great. So people will come to see that. They will come, they will spend. And our economy will be rocking. Plus you do one thing. Convert it to a financial services hub. And look at Singapore. Singapore has done that. So first let's put this very positively. So this is what he was advised. He said, fine, I take this advice. This makes sense. So at least my economy will be rolling. Then he starts one by one. What he does is, very good, very good. What he does is, he comes around and he floats a number of companies. Please note, the Dubai Sheikh family floats a number of companies. Now, these companies pick up loans from the market. They go to banks. Excuse me, today we are all scared. But I am talking of 2000, 2001, 2, 3, 4, where banks were just like, what is it? Tell me, I'll give you money. Okay, right? You don't want money, keep it, yeah. Do something with it. Okay, the last I heard was these guys are now not giving credit cards to eligible people also. They're that scared. But those days they were ready to give credit cards to all and sundry. Okay, it's a fact of life. Please understand. Nowadays banks are, thank you sir for your smiles. Right, banks are cagey. Those days, okay, possibly out of touch in business. Banks were much more, ask the seniors, they were much more liberal. So banks one by one started lending to the Dubai government. Now what I'm sure has got your attention, this is what I wanted you to come back and relate to is, November, forget the date, I think 24th or some date, there was a payment due to the banks. This is where the case erupts. There was a payment due to the banks. Now since there was a payment due to the banks, it's interesting now, since there was a payment due to the banks, what they said is, okay, there is a payment due now. So he just put up his hand. He just put up his hand and said, I can't pay. The banks went up and said, you can't pay? Why you can't pay? I don't have money. Liquidity was right. Then they started going back and saying, you see, these companies are saying they don't have money. This is known as, the jargon is corporate default. This is known as corporate default. That means the company is saying, I can't give you money. Corporate default is a jargon. Then the question comes is, who owns companies? The Dubai government itself, the Sheikh himself owns. That means this is not a corporate default. What is this is, I asked jargon for this page, what is this is nothing but a sovereign default. Markets get scared if there is a corporate default. They get hyper. They get paranoid if it is a sovereign default. For those of you all who are wondering, please understand, a sovereign default is one of the worst defaults that can happen. It is a country which is defaulting. Then there was panic in the markets. Now let me just come back and relate it to balance sheet. Last two lines, there was panic in the markets. People who were ready to give loans now were moving back. People who were ready to give loans were moving back. People who were still ready, right, and could be coaxed, said, okay, we will give it to you. Actually, we don't want, but we'll give it to you, Mr. Dubai government, right? But then we'll give it to you. Now I need an interaction, and I'm going to put it right here. Now I'm going to put it there, right? Okay, now this is where I want Mr. Anuj to respond. So before the default, let's say the Dubai government was getting money at 4%. After the default, okay, so there was a period where they used to get money at 4%. Then they have announced that, oh no, we can't repay back. After that, many of the people, banks said, we are not lending, we are not lending. The ones which are lending, let's say Mr. Mishra is now still ready to lend, okay, gracious of it. I need you to respond, sir. Do you think he will lend at 4%, less than 4% or greater than 4%? Why did you say that?
Because
there is the first principle of finance. Thank you. I'm preparing, I'll use the language. Finance is based on two principles, Sanjay says. Okay, that's all. Mishra sir, the two principles of finance. With your permission, I'd like to rub this part. The two very simple principles of finance. You applied it. Logically you applied it without even realizing it. It was that the two principles of finance is one, risk versus return. Second principle of finance is two concepts, two principles. That's it. Finance is logic, finance is two principles. The entire subject of finance is on these two principles. One is risk versus return. Second is, again let me quiz you.
Time value.
Thank you. Loudly.
Time value of money.
Second is time value of money. We will visit time value of money after 2 minutes. We will visit time value. I promise this. Today I am going to open yourself out to finance. That's all. And respected seniors, I am just now going to teach. I am just going to say, sir, I said देखिए finance. Time value of money. Okay, let me quickly finish that also. Sanil sir, I need your help again. I am ready to pay you 100 rupees now, senior. I will pay you 100 rupees after 1 month. It's a very simple question, sir. But right, which one would you prefer, senior?
Which is getting now.
Why? Because there is a value of time to money. Two principles: risk versus return, time value of money. That's all. Let's come back to this case and finish it. Look at this subject of finance and see how it is going. Now, people who are ready to give also are asking for 9%. Why? Please understand, the risk is higher. Now, my last question, and the entire topic is over. Balance sheet is open. The question that I am asking here is a very simple question, for which I would request anybody to participate. Now that I have reached out very all of you, the amount due was 8 billion. Amount due was 8 billion. Okay. Akhil comes and tells me the shake is worth 10 billion. The shake is worth 10 billion. Akhil comes and tells me the shake is worth 10 billion. So I am only wondering, amount due was 8 billion, shake is worth 10 billion. So why does not the shake simply cut a check? Simply cut a check for 8 billion and give it. He is worth 10 billion. He has put his money in real estate. He has put in money in, where has he put his money? He has put in money in some financial services sector shares, US. He has invested in money in finely bred horses. When you have a lot of money, you don't really know what to do in life. Shake is worth 8 billion. That's okay, that is a figure which is there on paper. If he said, thank you for your smile, sir. If he sells all those assets today, can he raise 8 billion? Answer is no. Shake is worth, sorry I stand corrected, 10 billion. 10 is the figure I use. If he sells all those assets, will he get 10? I don't think he will get even 8. First thing is, he didn't want to bail out the company. Second, just assuming that he wants to bail out the company, right, he can't, because we are talking about the third factor in business, and the third factor in business is solvency. And what indicates solvency? It is the balance sheet which indicates solvency. Welcome to the world of finance. I'm happy that for some friends it's going to be a recap. A balance sheet will indicate solvency. What is solvency? What is solvency? Solvency is the current market value of your assets. If you can sell it, and sometimes it gets into distress sales, especially if you are in trouble, then you have to, thank you for your smile, sir, then you are finished. Then to 60 lakhs will be 1 crore. 1 crore you feel good. I am only asking a simple question to each one of you, and I want a response. I want Mr. Kapil to finish it. I am sure he will finish it. Who will look at it? So what, first thing, before I'll give you 2 minutes. Profitability, profit and loss. Cash flow, liquidity. Balance sheet, solvency. Dear friend, young friend, who looks at a balance sheet? Among all the stakeholders, dear friend. Who do you think? And I'm sure you know the answer. Maybe I'm not. I told you he would answer. Bankers will start by looking at balance sheet. It's the logic. Who looks at profit and loss statement? Everybody looks at it. Both of that goes without saying. But the shareholder will be the first one who will come and say, am I making money? Who looks at cash flow, or who should look at cash flow statement? Sir, I am not saying they should not look at the other two. But primarily, first, who should look at the cash flow statement? Management. Sir, can I keep sustaining in business? Do we have enough liquidity? Who would look at the balance sheet statement? It is the lenders. He said lenders, I said bankers. I will go with lenders. Balance sheet is a static statement. So here we are. These are three statements. Now we are going to look at this statement. Then we are going to look at this statement. And we are going to look at this statement. That's it. We are going to do today. And we are going to speak the language of finance. Balance sheet is a static statement. Today, balance sheet. In India, we prepare financial statements. That's the way we operate. Right? That's the way we operate. Right? As on end of March. Same concept is used by multinational companies. They say end of December. So you select the date. You select the date, we will have a static statement. So we will cut it there and say stop. So it's a static statement. Balance sheet, Mr. Anuj, is always as on a date. Balance sheet is always as on a date. Liabilities and assets. Sir, I have a very simple way of doing this. I want to see that smile, and I don't know how others would have introduced this to you all. For me, what is liability? Please look at my way of doing it. What is a liability? Liability is source of funds. What is asset? Asset is application of funds by the company. Three principles to understand balance sheet. First principle. Imagine the company to have a separate legal entity. Three principles. First principle. Imagine the company to be a separate legal entity. Separate legal entity. So when I say Reliance Industries, please do not confuse it with Mr. Mukesh Ambani. No. Imagine, thank you sir. Imagine Reliance as an artificial person standing in front of you. Imagine Gabriel as an artificial person standing in front of you. Imagine Grasim, Spicer as an artificial person standing in front of you. So here is an artificial person. What is a liability? What is the source of funds? What is assets of the company? Where is the company applying that money? That's all. So when you say balance sheet is a statement of liabilities and assets, what it means is you are talking about an artificial person, which is extremely important. Thank you, sir. Second, where is that artificial person getting the money from? Liability side. Where is the artificial person applying that money? Asset side. What are the two forms of liabilities? That's it. Mr. Yashpal started. He said, my own money, which is known as equity. My own money. Then Mr. Rajesh finished it. Suppose you don't have the own money, full own money. You have it, great sir. Normally we don't have. Then what would you do? Simple. You will take debt. What my seniors called as loans, I am calling it as debt. So what is equity? Equity is nothing but, here it is, owner's funds. What is debt? Outside funds. That's it. आप लोग ने बताया, I didn't say anything. I said I want to buy a house. Please help me. So moment Mr. Yashpal said I want my own money. But I am short, no? Okay, Mr. Menon, if you are short, go to a bank. Bank will give you a loan. That's what a company does. A company has, right? A company has equity, which is owner's funds, and debt, which is outside funds. With your permission, I'll drop this here and I'll put it here. Owner's funds. Debt is outside funds. Debt is also known as leverage. Applying a small force, you can lift a heavy load. Lever is, I have 20 rupees, I have 20 units, 20 crores, 20 lakhs, 20 units. If Finance is unit free, it's logic. I have 20 units, I go and borrow 80 units. I can now buy a property worth 100 units. Thank you, sir. I have 20 units, I go and borrow 80 units. I can now buy a property, I can buy an asset worth 100. Debt is your lever. By having 20, I can buy something worth 100. That is why debt, the moment we say there is leverage, what does that leverage mean? What does that finance guy trying to communicate? He is trying to communicate that we are depending on debt. A leverage ratio is nothing but debt to equity ratio. A leverage ratio is nothing but a debt to equity ratio. What is debt to equity ratio? How much of debt? Thank you. To how much of equity? How much of debt? How much of outside funds to own funds? That is my starting point for valuation. I am not getting into valuations. This is more of a base and intermediate course. So I want to give a flavor of an advanced course. It's important. We start with debt equity ratio. When somebody stands here and says leverage ratio, leverage 2:1 leverage ratio. That means, what does it mean? 2:1. Rajesh sir, what does it mean for every, Sunil sir, for every 1 rupee of your own, you have borrowed 2 rupees. The best thing about debt is, why do companies depend on debt? This is a very important strategic decision. I will only cover this side before we take a break. But I am going to talk about a lot of strategic issues here. So why do a lot of companies depend on debt? The reason is not far to seek. So let me show you the reason why do companies depend a lot on debt. Debt, let's not get into taxation at this stage. When I get into profitability statement, profit and loss, I'll show you taxation, pre-tax, post-tax. I'll show it to you. And tomorrow, obviously, you've got a session on taxation, but that beyond, I forget everything else. Just take that there's a cost of debt is 11%. Okay? Don't bring in taxes here. Okay? I take that loan at 11%. Somebody wanted me to bring in the perspective of ROI, and I'm doing it straight away now, the first session. And I have 3 more sessions where I'm going to keep recapping. So I raise money at 11%. I raise money at what? 11%. I invest. Return on investment. I invest this debt. So when 11% के लिए उठाया, I run a business. Maybe I manufacture air conditioners, maybe I manufacture cement, maybe I manufacture kitchen appliances, something I do. And then on that return on investment, I take that money at 11%, I invest in a business, and that business is rocking. It is giving me 17% returns. The business is doing very well. It's giving me 17% returns. Excuse me, after paying the bankers their 11%, the 6% belongs to whom? Sunil sir, the 6% belongs to whom, sir? The 6% belongs to the owner, belongs to us, belongs to equity shareholders. This 6% is known as spread. Roji? Yeah, I'm sorry. I promised all captains should be here and it will be here. I'm sorry. The moment I saw some colleagues noting it down, I realized here it is. All jargons will be here. You can review it. You can ask me to repeat it. Hello? moment you can service your debt, anything that you earn excess over and above the cost of debt is your money. It belongs to the owner. Now do you realize why companies like to take a lot of debt? Companies like to take a lot of debt because they always believe they are going to earn a positive spread. Companies like to take a lot of debt because they believe they are going to earn a lot of positive spread. Companies like to take a lot of debt because they believe, सर ये क्या आप टेंशन ले रहे हो सर, ये लोग 11% का तो मैं देके उसके ऊपर कमा लूँगा, that money is for us. But the problem with debt, Shvaji, yes sir, simple logic no. The problem with debt is it can become debt. Thank you for nodding. It can kill, it can become debt. Suppose you invest in that business and that business gives you 7% returns. Your spread now becomes -4. It is an example of negative spread. Thank you sir, thank you for your prompt response. If this situation continues over a period of time, one-off thing hai, if this situation continues over a period of time, this company will be declared bankrupt. This company will be wound up. Debt can become debt. Now let's finish this wonderful interaction and then I'll take any questions on this subject. Right? Let me finish and then I'll take all your questions. Generally we will break for tea. Excuse me. Who is the best one to judge this expected ROI? It is